party started. Well, thanks guys for coming. Today we have the pleasure of having John Mlynczyk on the call. John Mlynczyk is one of our senior tax partners here. The man, the myth, the legend. We're really lucky to have him get to learn his insight on business entities and his thoughts on new businesses, old businesses, and kind of what you can and can't do in some of those confines, and if you should maybe be thinking about switching things up. So I want to introduce the firm because we've already introduced the firm a few different times, and we're just going to kind of go with the same format we've been going with the last couple series. We're going to have Kevin Bell open us up to start with, giving us a quick update on what's been happening in Washington and what to expect going forward and what is actually law now from a small piece here. So I'll kick it over to Kevin. And
yeah, let me share my screen. Okay, so just a sec while I get this working. I froze. Can you? Hello?
we can see you, Kevin.
Well, there.
My computer just froze. My screen's completely froze, so my apologies. We've done this in the past. This is the first time that it's froze on me like that. Can you see the tax updates?
No.
We just see a black screen on there right now for you, but maybe try to stop sharing and share again. See if that works.
Got it. Okay, that does
There
that.
we go.
There we go. Okay, there we go. My computer just needed a second to catch up. Okay, so I don't want to steal from John's thunder. He's talking about some choice of entity today, but one of the things that I talk about is the tax update. So on Tuesday of this week, President Biden finally signed into law the Infrastructure Investment and Jobs Act. This is, we'll say, a part of his overall goal to pass significant legislation in terms of infrastructure, and it's just a part of it, kind of the smaller part. Now, this had bipartisan support for this infrastructure spending. There's a few minor tax law implications there, not much. So we'll go over those real quickly. One of the major implications of this minor is the employee retention tax credit that has ended for essentially most businesses as of the end of third quarter of 2021. There is an exception for recovery startups businesses, in that if they began operations after February 15th, 2020, and they have annual gross receipts of less than $1 million, then they can still claim the ERTC for fourth quarter. There are some limitations on the amount of ERTC that they can claim for the recovery startups, but it's still there. And one of the things that's interesting, it does not appear that the recovery startup businesses are required to satisfy the government suspension or the reduction in gross receipts tests that are in place for most businesses. The other major, I would say, tax implication in terms of this Infrastructure Investment and Jobs Act is the digital asset and cryptocurrency reporting. What this all is saying here on the screen is essentially that crypto exchanges such as Robinhood and Coinbase are going to be considered brokers similar to Charles Schwab and Fidelity, which means they're going to have to start issuing 1099-Bs, basically reporting sales of crypto along with their basis to their customers and to the IRS. Now, this is not supposed to take, this is not effective until 1/1/2023. Essentially, it'll come out in 2024 when you prepare your 2023 tax return. So for 2021 and 2022, it shouldn't be an issue. Now, another issue with the cryptocurrency is that this Infrastructure Investment and Jobs Act did provide that digital assets with a value of $10,000 or more are going to be considered cash when received by a person engaged in a trade or business. Now, this is important because when a business receives cash of more than $10,000, they're required to file Form 8300. Now, this is just to put the IRS on notice that, hey, somebody received this amount of cash. And the goal here is to help avoid money laundering and unreported income. Again, this also starts in 2024. Digital assets are going to be considered cash. For this purpose, I should note that digital assets, cryptocurrency, for example, NFTs, are still going to be considered property for purposes of capital gains and capital losses. That's what this act had set out as well, confirming in the IRS's original guidance on that. So they still should qualify for capital gains and capital losses. Now, the other part of Biden's grand plan is this, what they're calling the Build Back Better Act. Now, this has gone through this is the third draft, third iteration of this bill. And each time it gets smaller and smaller. And I'm just going to touch on some of the highlights in terms of the tax issues. There's significant tax issues here, but I'm only going to touch on 4 or 5 of them. So the state and local tax deduction, this is the itemized deduction. With the passage of the 2017 tax reform, this limited the deduction to $10,000. Well, the new draft would increase that limitation to $72,500 for married filing joint. And this would be effective for actually this 2021 tax year if it was to pass. The next tax implication is this surcharge on high income individuals, estates, and trusts. Again, it's another way to raise revenue for paying for some of this infrastructure spending that they would like to do. So it's going to impose a 5% surcharge on modified adjusted gross income that exceeds $10 million for married filing joint, and then an additional 3% on top of the 5% for adjusted gross income in excess of $25 million. Now, this is going to be would be effective if it passes in this current form, 1/1/2022, so this upcoming tax year. Now, net investment income tax, the bill would expand the definition and the definition of what income would be subject to this tax. As a brief reminder, this is a 3.8% tax on net investment income. For example, capital gains, certain tax capital gains, interest, dividends. And there are some types of income that would not fall within this. However, this act would expand the type of income that would be subject to this, and thus generating additional revenue for the government and to help pay for this bill. Again, this would be the proposed effective date would be 1/1/2022. Some final things would be they want to. This bill would also limit the backdoor Roth IRA conversions for high income taxpayers. Essentially, you make a contribution to a traditional IRA and then roll that over into a Roth IRA, make a contribution into a non-deductible IRA and roll that into a Roth IRA immediately, thus limiting the amount of income subject to tax, but then also getting the benefits of a Roth IRA. So that's another provision of this Build Back Better Act. And then,
Kevin, on that, am I remembering correctly that wouldn't kick in until 2031, 10 years from now?
that sounds about right. Yes. Yeah. That sounds, you're right. Yeah.
I mean, obviously it could change, but I think that was in the latest draft.
Yeah.
Change 5 times.
Yeah. And then the final one is that I want to talk about today is the act would expand the definition of required minimum distributions from retirement accounts, essentially for retirement accounts in excess of $10 million. I have a little typo here, my apologies. In excess of $10 million and $20 million, there would be different levels of required minimum distributions that would be in place. Some of them would require immediate distribution of certain amounts to get it to a balance, a lower balance, and then some would require just annual distributions. So again, this comes about due to certain taxpayers, it's been in the news recently about certain taxpayers who have benefited significantly or who have maximized the benefit to these Roth IRAs or even just IRAs in general, to the point where there was in the news about an individual who had $5 billion in a Roth IRA, and Congress didn't like that, so they're trying to curb that with perceived abuse of the IRAs. That's the last of my part on the tax updates.
Excellent. Thank you, Kevin. It's always fascinating how these infrastructure bills contain just a little bit of tax. Remember on the last highway and use bill that was aimed at highways and that kind of thing, all of a sudden we ended up with the change in tax deadlines. They always seem to sneak some of that stuff in there. I'm going to throw in a polling question here real quick, just to make us CPE eligible, or maybe not, if I can't get one question too long. Let's see here. Have you guys seen a poll question right now?
Nope.
Okay, well, I had them loaded. I guess it's not working. So, oh well. But they would have been awesome. So, the first question I had that I was going to pull is it was a get to know you question on John. Is that Mlynczyk is country of origin? I had 4 different options. We had Scottish, Irish, English, and Polish. So you can submit those polls informally now, and then John can let you know if you were right or not. So
We'll have to wait to the end for those that can't stand the suspense, right?
I had a few good questions there for sure locked in, but apparently the something in the system didn't work very well. But no, we'll kick it over to John. John is very knowledgeable in a lot of areas, and we're really lucky to have him. So we'll let John get going.
Let's jump in. Can you see my screen here?
Yep.
And did I make it worse? Let's just do this. So I just want to chat a little bit, kind of a high-level conversation without getting too detailed regarding choice of entity selection, and when you're either setting up a new business or if you've been established in a business for a while and for whatever reason now you're thinking it may be time to switch the type of entity that you are. And some of you may have heard there's kind of the big 3, if you will. We have LLCs or limited liability companies, S corporations, and C corporations. Before I ever give a recommendation on choice of entity, I don't know if we have any attorneys on the call, but I always recommend to the client, hey, this should be in a collaborative effort with your attorney. Oftentimes the attorneys will defer it back to the CPA. It's a little bit of a game of ping pong, but that's because most of these entities all have very similar legal characteristics, and the attorney will defer it back and say, well, what makes the most sense from a tax perspective? So that's really what I want to focus on, are the tax perspectives of these different types of entities. LLCs, and feel free to jump in, ask questions, raise your hand in the chat. They're flexible. Single member LLCs are completely disregarded for tax purposes. So the results of your business that's run through a single member LLC is shown directly on your tax return. Oftentimes that's on a Schedule C, E, or F. So if I have a new client coming in, it's a small startup, they don't have a lot of employees, they're just getting going. Sometimes single member LLC is often the best way to go. It's very easy to set up, convenient. There's no separate filing. It's all on their personal tax return. Then the other flavor is a multi-member LLC. So, if Brent and I are partners, or Brent and Kevin and I are, 3 members of an LLC, we get to pick. The default classification is a partnership, but you can also check the box and make an election to be taxed as a corporation, including an S corporation. So there's a lot of flexibility, but I would say 95% plus of multiple member LLCs accept the default classification as a partnership. So here's some of the pros and cons of each area. And you may start to see a bias of mine as we kind of march through this, but LLCs are very favorable in many situations. For example, when you buy into an LLC, for example, if I bought Brent's LLC membership interest for $100,000, I may want to take a current deduction for some of that purchase. And with an LLC format, I may be able to depreciate and or amortize part of my purchase price. So that's favorable to me as a buyer. Similarly, if the LLC exists and we want to redeem Brent and buy him out, the remaining members want to get some deductions for the monies that they've spent and incurred to buy out Brent. So with respect to buy in and buy out, we get to deduct some of those. That's helpful. Members receive tax basis debt in their allocations. What does that mean? That's really important, actually. If I'm going to pick on Brent throughout this presentation, but go in and we're partners, and let's say we're running a dry cleaning business and we need to go buy a new piece of equipment and it's $100,000, and we buy that with debt from the bank, we get to use that debt for purposes of offsetting deduction items because we need that basis in that equipment in order for us to take depreciation deductions. It's a different game, different strategy on the corporate side. So this is a favorable thing, and we get tax basis in the debt. Generally, it's tax-free to set up an LLC. You can put your property in, you can put your cash in. Generally, no harm, no foul. So that's nice. It's flexible. Generally, it's pretty easy to get out of an LLC. You can distribute property out. You can liquidate generally without tax friction or tax considerations. So that's positive. There's always exceptions, but I'm just talking the high-level general rule. Members, a few years ago, in 2018, tax laws changed. A new deduction came on the scene called the qualified business income deduction. I feel that with an LLC structure, you could potentially optimize that for some of the members versus in a corporate form. Payroll or wages aren't required for an LLC. I mean, obviously, if you have rank and file and employees, you'll have to have payroll, but for the owners, for the members, payroll is not required. And, this is maybe a downside or a detriment, but members may be subject to self-employment tax on their share of profit. But there was a lot of positives, and that is a detriment, if you will. So big picture, LLCs are pass-through entities, meaning they don't pay tax at the entity level. The allocable share of profit is passed through to the underlying members. Each member receives what's called a Form K-1 or a Schedule K-1 that flows into their tax return. This last bullet can be a tricky concept, but what I'm saying here is members pay tax as their profits are earned and not paid out. So you could have a partnership, and my share of profit for the year might be $50,000, although the partnership may decide to hold that back in the partnership bank account. My K-1 is going to have $50,000 of income on it. I'm going to have to pay tax on that income, whether or not I get the cash. So the tax bill doesn't follow the cash, it follows when the profits are earned. On to the S corporation. We talked about in the LLC, you get a basis adjustment and you get to depreciate that. On the S-Corp side, if I paid Brent $100,000 for his S-Corp interest, I don't get to depreciate any of that right out of, I have to wait all the way until I sell my interest, and that could be years down the road, to recover that investment cost. So that's not desirable. Profits and distributions have to be allocated in accordance with ownership. On the LLC side, it's very flexible. You can allocate things in many ways. Here, we have to do it in accordance with ownership. I don't get basis in my corporate level debt. So if I go to the bank to finance a piece of equipment, I can't use that debt and basis. That may limit my ability to take deductions related to that debt. S-corps are more rigid in who their owners can be. You have a limitation of up to 100 shareholders. Generally, those have to be individuals. There's a few select types of trusts that work, but that's the general rule. So you can't have an investment partnership be a member of an S corporation. And oftentimes that will trip you up because oftentimes you don't have individuals that want to be shareholders. You have other types of entities. Generally, you can set up an S-corp tax-free. It's easy to contribute cash or property. So that's not too bad. But on the flip side, liquidating an S corporation or getting property out, those are taxable events. So we're losing some flexibility on the back end. Similar to the LLC and the new QBI deduction, shareholders receive a QBI deduction, but it's going to take a haircut because S corporations require their shareholders to receive a reasonable salary, and QBI is not allowed on wages. It's only allowed on pass-through profits. So to give you a very simple example, if I had an LLC and I made $100,000 with no salary, potentially all $100,000 is QBI eligible. However, if I had an S corporation making the same $100,000, but I paid myself a $50,000 salary out of that, now I'm only receiving the residual $50,000 as being eligible for QBI. So that's a detriment to the S corp and QBI. One of the things that I see often is that S corps are set up and whoever is setting them up is hyper-focused on saving on self-employment taxes. In my mind, that's important, but sometimes it's very short-sighted. You can save monies on self-employment taxes with an S-corp structure, but remember, you have to pay yourself a reasonable salary. And also remember, with the new QBI deduction, your QBI deduction may outweigh any self-employment tax savings. So really, I think you have to evaluate all these things, not just focus in on the self-employment tax savings. Similar to the LLC, S-corps are pass-throughs. They don't pay any tax at the entity level, generally speaking. Same thing, they get a K-1. Same thing, they pay tax. They being the shareholders, pay tax as their profits are earned versus when they're paid out. C corporations, probably the least likely. If you had 100 new clients walk through the door next week, this would be the smallest percentage, I would imagine, of new businesses being set up. Over time, C corporations were more in favor, but I would argue that now they're out of favor for a number of reasons, but they still have value in the right circumstances. No adjustments for basis, buying in, buying out. So it's just like the S-corp, generally tax-free to set up, except you've got to be careful if you're contributing property, which you've maybe previously depreciated and you've got little or no basis in it. Maybe you have some debt on that property. When you contribute debt in excess of your basis in property to a new corporation, that's a taxable event. So we've got to be mindful of that. No QBI deduction because C corps are not pass-throughs. So there's no QBI allowed. Corporation tax rates have changed over the years. As we sit here today, they're 21% federal, 6.6 or 7.6 to Oregon. And then this is the biggest detriment to a C corporation, but you're potentially exposed to a double tax. So for example, if my corporation earns $100,000 of profit, I'm going to have to pay federal and Oregon tax at the corporate level. Let's say on a combined basis, that's 25% or $25,000. That leaves me $75,000 in the business. And if I want to take it out of the business and put it in my pocket, then I pay another tax on that distribution as a dividend coming out of the company. So C Corps are not very tax efficient if you're going to be taking cash out of the company. If you leave cash in the company, that's a different set of facts, but C Corps are subject to a double tax. Also subject to a double tax in liquidation. So you don't want to be selling or liquidating your C corporation. You'll be subject to a double tax in that regard. You might say, John, well, this is crazy. Why would anybody set up a C corporation? This sounds all bad. But there are some benefits. There's a kind of an esoteric code section called Code Section 1202, which allows for tax-free, in some instances, sale of your C Corp stock. You see this a lot in the tech industry. If they start a small corporation and they hit it out of the park and somebody buys them for $1 gajillion, there might be an opportunity there to capture 1202. Although some of that may change under the new tax rules coming down the pike. Shareholder fringe benefits. There's a few perks as it relates to shareholders. For example, a shareholder of a C Corp can participate in a cafeteria plan or FSA, things like that. They can't do that in an LLC or an SCorp. Got some fiscal year flexibility. You can pretty much pick whatever year end you want to get started. No K1s. This is it's kind of simple, but some clients just don't want to fuss with a K1 and all the nuances hitting their tax return. So if you want to get rid of it or manage income on the personal level, C corporation may make sense in that instance. So that's kind of the lay of the land: LLC, S Corp, C corporation. But oftentimes, when we're meeting with clients, somebody else set them up years ago, or for a variety of reasons, now they want to maybe switch. And so just a couple things that you need to keep in mind. If it's easy to go from an LLC to a corporation, it's difficult to go from a corporation to an LLC. To go from an LLC to a corporation, it's generally tax-free. However, watch out for that liabilities in excess of basis that I touched on a moment ago. Why would you want to go from one to the other? I've seen a variety of things. The 1202 stock, I started a company as an LLC. Now I'm seeking outside investors, crowdfunding, simplify my K1 reporting, fiscal year. LLCs are fantastic, but they don't necessarily have the same status from a historical perspective as it relates to some state law issues. In particular, contractors have state law and bonding requirements. Sometimes that can be more challenging as an LLC versus an old school corporation. Developers, in particular property developers, there's some special rules to using corporations versus LLCs. So there's some nuances. It really depends on the type of business, how you're going to operate it, that sort of thing. Now, on the flip side, converting from corporation to LLC, this is one where you need to be very careful because basically converting from corporation to an LLC is, if you just flip the switch and you do it without any planning, that could be a deemed liquidation. And it's a fully taxable event, as if you sold all the assets of your business. That could give rise to an unexpected tax bill and an unhappy taxpayer. Property distributed out, also taxable. So it's tricky. So there's a couple things. You might say, well, what can we do? Well, we can consider just a simple state law conversion. So I've done this with a few clients where we've always filed a tax return as an S corporation. but now they desire to be an LLC for operating purposes, state law purposes. So we simply go to the state of Oregon and we file an article of conversion. The client files, now they're LLC, but for tax purposes, nothing has changed. We're still filing a corporate tax return. So the IRS gives you some flexibility there. That they basically say, we don't care. We're still going to treat you as an SCorp, even though admittedly it looks goofy because at the top of the tax return, it'll say, XYZ LLC, and then, but it'll be on a corporate tax return, but it does happen. The other option might be what's called a drop-down LLC owned by a corporation. This might be a strategy where, okay, you have an operating business, you set up a new corporation such that your existing corporation forms a new LLC. That's called the drop-down LLC. And now you're going to take all the assets of that corporation and put them into that new LLC. Put them into the LLC is the complicated part because there's retitling of assets, there's debts to worry about, but assuming we can do all that from a legal perspective, now we have a corporation that owns the LLC as its only member. So we're still filing a corporate tax return, but the underlying business is now inside of an LLC. Maybe that LLC wants to admit a new member and that LLC becomes a partnership. That's doable. That's a drop-down LLC strategy. We're climbing up the ladder of complexity, but that's doable. And this is Kevin Bell's favorite strategy, the corporate inversion strategy, which is maybe the most complicated on the list. And that's a strategy where you take your corporation, contribute it to a newly formed corporation, turn the old corporation into an LLC, and make sure that you do that in a very timely and strategic fashion to not run afoul of any of these rules. What you're left with at the end of the day is a corporate owner of an LLC, and that LLC now is disregarded, and it can invite new members or it can stay disregarded. That's another idea. There's a number of other strategies, but those are the ones that we see the most. So just a couple summary slides here. LLC, some take-home items. LLCs will maximize flexibility, in my opinion, potentially maximize QBI. Members receive basis in their entity level debt. Generally, that's favorable. Members receive depreciable basis adjustments when they're buying in and buying out. Generally, that's favorable. Contributing to and taking assets out, it's generally easy to do. No restrictions on ownership. So I personally really favor the LLC, but in certain instances, the other entities have their place. S-corps are more restrictive. Allocations in accordance with ownership, owner restrictions, you have to do payroll for the owners, potentially reduce QBI, no basis in corporate level debt. Property distributions are generally taxable. These are all negative attributes of the S corporation. Kind of a positive attribute would be a potential payroll tax savings. And there's some nuances with developers and contractors where S corps make sense. But in my estimation, the LLC probably has more pros than cons. And then in the right circumstance, a C corp can make sense, but oftentimes, I would say 9 out of 10 times, you would steer your client towards an LLC or maybe an S corporation. I blew through that quite quickly, but I'm happy to field any questions. Go from there.
John, I've got a question for you. If I'm a new, we have one, let's let Courtney go. Courtney's got a question in the chat here.
Is that check going to you because I can't see it?
No, it's coming to everybody here, but I'll let you know what she says.
Okay.
Or she can unmute herself either way. Oh, there she goes.
Oh, okay. Oh, sorry about that. I unmuted myself. Can you hear me?
Yeah.
Okay, great. I'm at work, so that's why I muted you, just in case I had to help somebody. So, what would you recommend then? Currently, I'm an LLC. I have a travel company and also a boutique here in Corvallis.
Mhm.
But I do a lot of business overseas in Korea.
Mhm.
I've been so even though I'm an LLC, I've been talking to my accountant just very loosely about an SCorp or a different format for myself if I'm going to also register a portion of my company overseas. Do you
Mhm.
still recommend an LLC?
Well, the international component is really outside of my wheelhouse. There's some nuances there that, I can't really speak to. That may be a compelling reason that would require you to maybe spin out part of your business and change to something different, or maybe change the format altogether. But the fact that you're already an LLC, to me, says, okay, you're in a great starting place. You're going to need something very compelling to move you to a different entity type. The international component may be one of those things. I just can't speak to that because that's not a practice area specialty of mine. So you'll have to visit with your accountant on that particular nuance.
Okay.
John, do you mind if I jump in just a little bit?
Sure, Kevin.
I'm not gonna be able to say what type of entity. I just as a little bit of a background, I work a little bit in our international tax practice, and various international tax issues come through my office. When you, Courtney, talked to your CPA about that, and you mentioned registering in this in a foreign country, you'll really want to look at how the IRS treats that registration, and if you have to set up a business entity in that foreign country, because the IRS will look at foreign entities and they will be treated in different manners. And I can't go into all of that here on this type of a call, but there is some very tricky stuff with how the IRS treats those. Not only that, but the type of domestic entity, the US type entity that you have that owns or holds that particular entity. So there's a lot going on there for you. And yeah, in your situation, it'd be really good to talk to your accountant a little more in depth about it. And just want to echo what John said, but there are some potential international issues as well to a choice of entity issue.
Okay, great. Thank you very much.
You bet.
So, John, I got a few questions for you.
As long as they're not international, because those are tricky. I'll give them to Kevin.
They are not. I'm glad Kevin was here, but when I hear international, my ears perk up and I get scared, and then I start talking to Kevin. If I'm starting up a new business and I'm walking in off the street, what's going to be the most likely scenario?
What's going to be the most likely?
Yeah, what's my likely entity route, and where am I going to end up?
Tell me a little bit more about your new business.
Let's say I'm just selling widgets on Amazon, and these are the calls I get, once every couple of weeks through our phone lines. So, what's the typical flavor for a new startup?
Do you have employees?
No,
You plan on having employees?
in a couple of years.
Do you plan on having a partner in your business?
Not at this time.
Okay. Well, you see, I'm teasing that out, and we're kind of teasing each other right now. But those are some of the follow-up questions that you should be thinking about the downstream consequences of making the selection now, because you really need to think through to how am I going to be using this business, not just today, but 5 years from now? Do I envision it growing? Do I envision other partners? Do I envision, all those things? But to give you an answer, based on kind of what you said, I would probably recommend, a single member LLC. From a tax perspective, obviously, I'm going to say consult with your attorney, make sure that they're okay with it. We can have a conference call, talk about it. But from a tax perspective, it's simple to set up. It's going to be a component of your personal tax return. You can grow that single member LLC into something else. You can add a partner down the road. You can add employees down the road. Not only that, so you set up the single member LLC. Equally as importantly is you need to treat that like a real business. And so you need to have a new bank account in the name of that LLC, a tax ID number, etc. But that is often a go-to entity for a startup business of just about any type. Good question.
That's a good answer. I've got one more if no one else has any questions, and then I'd like to reattempt the polling questions so we get to know John better. John, are there just certain industries that are going to force you into certain types of entities? Real estate, for example, we're often told, don't put that in a corporation. Are there any other, specific industries out there where your entity is kind of defined by that industry?
Yeah, that's a really good question. Real estate is a good one to pick on for a second. So the ownership and holding of real property or real estate causes some tax friction in a corporate format. So I would say in an SCorp or a corporation, it's tricky to have real estate in those types of entities. And the main reason for that is, well, what if I don't want it in that business anymore? I just want to take it out. And, if I put a piece of commercial property in my corporation, and then 5 years from now, I want to do something different and take it out, well, that's a taxable distribution at fair market value. And I don't have any money to pay those taxes, but I just want to do something else. So I don't have that flexibility. So I would say holding and owning real estate inside of a corporate form, it's kind of like oil and water. They don't mix very well. But on the flip side, if you're in the business of developing real estate, and you've got the company that owns the bulldozers and you're putting in all the road work and all the infrastructure, corporate format might make a lot of sense as a developer because there's some potential tax benefits there. Corporate form is maybe advantageous from a state law standpoint or from an insurance standpoint. You may not own very many assets in that corporate format. So those are a couple examples. But really, there's really no one fits all. You have to really think through how are you going to use the business? What are the anticipated downstream consequences, if you will?
I might throw one out there, Brent, just because I've looked at this a little bit, is the cannabis industry. Under state law, it's legal, whereas under federal, it's not legal, marijuana. So some of the things I've seen is that there tends to be a higher propensity to use C corporations that John talked about. They're not the most tax advantageous entity setup, but they do allow for an isolation of tax issues from the shareholders. Mm-hmm. So if there are tax issues at the entity level, then there's less of a chance that it'll seep down into the shareholders and impact their individual tax returns. Now, do all cannabis companies use C corporations? No, but that in the early stages, that's one of the entities of choice, but that was from a legal standpoint, a legal risk. So I throw that out there as maybe one industry.
That's a great comment. And I would add to that, you know, if you had a client that walked through the door tomorrow and they said, I've got a great idea, maybe it's Brent's idea, and we're gonna go out and seek investors tomorrow, and we're gonna start to raise capital and get this thing off the ground. That'd be another great example of how a corporate structure might make a ton of sense from a compliance standpoint and making it easier on everybody that's involved. And the potential for 1202 stuff.
All right, well, I'm gonna see if I can launch these polls here while people are thinking of any other exciting questions. I want to see if this works here. Can everyone see this question? I see we've got a split decision here on our questions. John, what is the correct answer?
You can't show the breakout data.
Am I not showing it right now? So here, there it is. Can you see it? Everyone see the polling data?
I can't see it.
Oh, there we go. Now we can see it.
Definitely Polish. That's the answer.
So that was one there. Now we're going to see if I can get the next question to go here. All right, John enjoys for his hobbies in question.
Really picking on me on these polling questions. It's
These are getting to know John.
a little uncomfortable.
I've only got 5 of them, so.
Brent, what is ultimate?
It's ultimate frisbee, but if you call it ultimate frisbee, people that play it get really upset because frisbee is a brand. So you just call it ultimate.
Got it.
So that's. So there we go. We've got some answers. So here's our result. John, did we get it right?
Yeah, well, actually, it's a good split. I enjoy jiu-jitsu and pool, so good. But yeah, I have trained Brazilian jiu-jitsu for off and on for the last 10, 12 years. So it is a hobby of mine.
This one's one that I think will be pretty apparent based on John's. John's favorite partner in the firm. Probably tougher for some of those that don't work around here, but
I'm picking Jennifer because she's not giving me a hard time.
I think it's the first one. Yeah, I got 2.
There you can see, Kevin. I did not make the list, which I'm not sure what that says about my personality on this call. But
Any other
we've got
questions on the entity topic or discussion?
I might throw something out there just as something to consider is what's interesting is that tax law changes quite frequently. And if you remember a couple of years ago in 2017, there was the change in the corporate tax rates. They were lowered to 21%. So one of the big topics at that time was all these different business entities were considering converting to a C corporation. And from an LLC or an SCorp to a C corporation. It was very interesting that a lot of people were like, oh, lower tax rates. What we found out as we did through the analysis is that it could work, but it was required a very long time frame. And the reason I just point that out is you'll see that Congress will play with tax rates, which may make one type of entity more favorable over the other in the short term, but you have to look at the long-term perspective on what you're doing. Kind of getting back what John was saying is, does this really make sense for your facts situation? And what I saw is that for most of my clients, converting to a C corp was not beneficial, even with a 21% tax rate. So it's just something to be on the lookout for. As tax law changes. Just because it changes, it might seem beneficial now, it might not be beneficial in 10 years for your goals.
Great comment.
We got 2 more questions left to be CP eligible. So here we go. If John were an animal, he would be, and there's 5 answers. I'll go ahead and let everyone know I don't actually know the answer to this question for John. So we'll just we'll have to get his take on that.
There should have been an other. I'm disappointed that dog isn't on there.
That's true. I am an animal lover. I do have dogs and cats and chickens, but I picked a giraffe just because I'd like to be a little bit taller. So.
Honesty, that's what we love, John.
That's John always brings us something refreshing there. All right, last one. This one is, it does have an actual answer. So in college, John's major was, we'll see how well people know John.
So my major was math as an undergraduate, and as a post-bac, I did all my accounting courses. So.
Were you going to be a teacher?
Actually, I started off thinking I wanted to be an actuary, and
Oh.
then if you think accountants don't have personalities, I don't know if you've ever met an actuary.
Hopefully there's no actuaries on the call.
We'll make sure to send this to their share group. So
They would understand. They would agree.
they wouldn't argue about it. All right. Well, I think that kind of brings us to the end of things. We'll put this online on our website for everyone that wasn't able to attend tonight. But thank you guys for coming, and appreciate John stepping on and sharing with us this week. It was great, John. Really
I didn't know you were going to harass me with all these polling questions. So. Thank you, everyone. Have a good evening.
Thank you.
Thank you, John.